All right. Hello, everyone. Thank you for continuing to join us throughout the day here at the Lytham Partners Fall 2024 Investor Conference. My name is Robert Bloom, Managing Partner of Lytham Partners. And during the sort of afternoon keynote panel here, I'm extremely pleased to be joined by two individuals I've gotten to know over the last few years that not only active sort of in the micro and small cap markets, but I would also call maybe advocates for the general retail investor. I'll sort of allow both of them to introduce themselves here in a moment. But Tim Weintraub first is a portfolio manager with Alpha Wolf Capital, and Ben Rabazada is a founder of Story Trading. Guys, let's jump right in because I have a feeling we're going to be short on time here. So maybe to begin, Tim, give us sort of the quick, couple of minutes on yourself and maybe kind of how you got to sort of the place where you are today.
Okay. I've been a full-time investor. I've been an investor in the markets for 38 years. And I'm very passionate about the market. When I first got involved in the markets, it was really just about me wanting to make extra money. But then once I got bit by the market, I just happened to have first first stock out of the gate was a huge success, which is probably the worst thing that can happen to any new trader. Because you think, oh my God, this is the easiest money you can ever make. Uh, and then as I progressed and learned and went through trials and tribulations of being an investor, I wanted to make retail investors smarter investors. And so that they wouldn't be the butt of every Wall Street joke. And that I tried to do for about, I don't know, 10, 11 years. I would say I had very marginal success there. But what I have realized most recently is that the most important thing, I came into this world with nothing. I'm 99% sure I'm leaving with nothing. So what matters is what you do while you're here. And there are a ton of amazing companies out there that are small in nature, that aren't going to be on CNBC or Bloomberg, that aren't going to be touched. They're not going to be talked about by the funds, Goldman Sachs, Morgan Stanley, because they're too small. But these companies are attacking or finding solutions for huge problems that we face as humanity, and nobody knows about them. And to me, that's what going public is really all about, is to help these small companies that nobody knows about and put them out in front of the public so that they can, if it resonates with them, they can invest in the company. Why do companies go public? To raise capital. I mean, that's really why they go public, right? They sell off a portion of their company, hopefully to like-minded individuals that see their vision and want to be part of it. That is what I think the public markets were originally intended to do. I think that with algorithmic trading and all the stuff that happens nowadays, that's not what the markets are about, right? Very short-term thinking in nature. I'm a long-term investor, and that my goal is to try and help as many small companies become very large corporations that can do great things for humanity and impact as many lives in a positive way as you can while you're here. That's it.
Perfect. Ben?
Hey Robert, thanks for having me. So over at Story Trading, I've been got 20 plus years, 25 years probably, yeah, 25 years of experience starting as an individual trader, investor. I went through a lot of iterations. Started out as a fundamental investor. Then I gave a shot at technical trading, gave a shot at headline trading the headlines. And then sentiment trading, just like what's kind of, hot and in style right now. So after trying every one of these different approaches to trading, I came to a epiphany. And that epiphany was that there's a reason why a stock is priced where it is, right? As a fundamental investor, I was always very frustrated. Why is this stock perpetually undervalued? And I thought, oh my gosh, the markets are inefficient, right? As a technical trader, you're like, it's just a crapshoot, to be honest with you, as a technical trader. Same thing with a headline trader. You have like a positive catalyst and the stock goes down. Why the heck is it going down? So after years and years of experience, I figured out that actually markets are efficient, right? And there's a reason why stocks are priced where it's at. If you found a stock and you think it's quote unquote fundamentally undervalued, it's actually because there is some issue there, some usually sentiment issue. Um, and at story trading, what we try to do is time our investments based on catalysts which which turn a negative sentiment on its head, right? Or turn fundamentals on its head, right? So if you identify why is this particular company undervalued, you identify that reason, and when that reason becomes solved, right? There's a catalyst out there. Maybe you find out through your research that, hey, this small little company is undervalued because they have too much concentration risk, right? So when they sign a deal, even if it's not a significant deal, but they're making an effort towards diversifying their revenue base, then the market would look really kindly on that, and then you can have rapid re-ratings, right? So at story trading, a lot of the topics we're going to be covering today about retail investors, a lot of it touch on the topic of sentiment, and it's going to be really fascinating. Can't wait to go through these topics with you, Robert.
Let's sort of start there, right? So when you look at the differences between the approach from an institutional investor and an approach from a retail investor, right? And we can argue what retail and institutional, the definitions, but I think we have a general idea there. What do you see as the main differences in terms of how they approach their research? And maybe Tim, start on your side.
Well, I can tell you that from my experience, most retail investors don't do really any research on what they own. They buy their stock because they heard it from a friend, or they heard it off of Reddit, or they heard it off but do they really know what they own? Do they know what the cap table looks like? Do they have any idea how big the TAM is? Do they even know what a TAM is? I mean, they're to me, for a lot of retail investors don't know what they own. That's why they have no conviction in what they own, right? It's hard to have conviction in something if you don't know what the real story is, right? Institutional investors have all kinds of, look, they're going to talk to management. They're going to, look at the TAM. They're going to look at the competition. What's the differentiator? What's the moat that this company has? There's going to be a whole lot of, that's if institutional investors are looking at a company. If it's a big fund, they're not going to look at a smaller micro cap name. They can't. They're too big. So really, it comes down to some of maybe the family offices that that are going to look at some of the smaller micro cap names. But for the most part, I would say it's retail investors. And I'm not going to say all retail investors don't do their homework, but a lot of retail investors focus on the past quarter, or a missed execution. Those things are not worth talking about, because I care where a company is going, not what happened. I want to know where we're going, right? And nobody has a crystal ball, and it's easy to Monday morning quarterback, but life happens and challenges come up. Who would have thought we were going to have a pandemic? And then this biggest supply chain issue in history. And then the fastest interest rate hike cycle in history, right? These are all things that a lot of small and micro cap companies have navigated through. And actually, even their companies have gotten stronger. Their stock's down 70 to 90%. And that's because of the entire sector, not because of something specific to the company.
Ben?
Yeah, fascinating. I probably have a little bit of a different take on here. I think that the biggest difference between institutional and retail is sentiment, right? And retail investors are primarily looking at sentiment, primarily looking at vision, primarily looking at ideas and words that management's talking about, what they're going to do, right? And in some cases, in many cases, this hurts them, right? In many cases, it hurts them because they don't understand capital structure and fundamentals, and this company might need to raise money. But in some cases, it helps them. And interesting, look, you talk about meme stocks, and retail investors have a bad reputation about meme stocks because of like AMC and GameStop. But these retail investors were also the ones who were in Tesla early with diamond hands. They were also in Palantir, believe it or not, early with diamond hands, right? And the commonality between, maybe they got lucky with Tesla and Palantir, but really what they're doing, you made a comment, Tim, which I actually disagree with, that I think it's institutional investors that are primarily looking quarter to quarter, and they're trading. They're either transactional in the market, because of offerings and they're shorting it or warrants or something like that. They're either there transactionally or they're there trading the market quarter to quarter. Whereas retail, they have a very long-term vision. Most retail that I know, that I see on social media, they're like, what does it mean to invest in a company? It means you believe in their vision and you want to be there long-term. So what happens is you have a lot of retail investors, whether they're right and they got lucky with Tesla and Palantir, or whether they're wrong with GameStop or something else, but they're in because they believe in management, they believe in the vision, and they're there for the long term, irrespective of what happens quarter to quarter, because quite honestly, they don't even understand it, right? And they don't understand what's happening with the balance sheet and the capital structure and everything else. So, being very sentiment focused, I think, is the difference between retail and institution. And in some cases, it helps them, and in some cases, it hurts them. But again, one very unique thing that I see out of it, I actually think retail, they're more investors than institutionals are. That's the way I view it. I think institutional, they're just traders, they're just transactional, they're just trying to make a buck for the quarter. Whereas retail, they want to be in a company and they want to see a 100x, 10x over the next 5, 10, 15 years.
I just, look, I think you make a valid point for some retail investors. I especially think with the younger generation, they want everything now, right? It's instant gratification. And
there's that too. There's different circles. You're right.
Right. So I mean, you have your. I would say my generation. Yeah, I can see where my generation, my age bracket would be that type of investor, right? The younger generation, and that's really who this is. I think could have a huge impact on the markets. The guys that are on Reddit. I mean, they were telling people to buy AMC at $72 and hold, right? I mean, really, really terrible advice. And what happens? The guy that bought at 72 and held, he's never getting that money back, right? He's going to be holding for a long, long, long time. I mean, Reddit, if you focused on companies that really could make a difference in humanity, and you got the consumer as well as potential investors and the industry to embrace something that is a solution that's obvious. It's not a matter of does it work, it's proven it works. Why isn't it being adopted? And that's because, and you brought it up, early adopters, right? That 13% of the population is what you would call the early adopter. Helping a company get from 13% to 20% is a huge deal. If you can get to 20%, that's when you start to escalate towards that 80% that you have to, 70 and 80% that you have to become the standard, right? To really have full adoption. Where Wall Street is terrible is they prime these companies to go public, saying that they're going to get institutional investors, which we know if you're a little microcap company, you're not getting any institutional investors. You're not going to get a Goldman Sachs, Morgan Stanley. That's not happening. You're not going to get on CNBC. It's going to be a rough go. And if you're not cash flow positive, right, that's where it gets even tougher, right? Because you've got to get to that cash flow positive in order for anybody that is, for any Wall Street people to like the story. There's a lot of would you agree that there's a lot of sentiment if the company is not cash flow positive or profitable, then most people on Wall Street don't even want to look at it?
Yeah, that's a big important deal, especially the last few years when interest rates were higher. If you have like a Goldilocks environment with low interest rates and Fed pumping money into the markets, then maybe you don't need that. But in most cases, it's a death knell, especially because of how these companies have to raise money through warrants usually, and then you get this open market shorting ahead of raises. You know, that's one thing I hate. I hate about the space, and is actually one thing I appreciate about the meme stock craze with the GameStop and the AMC. These companies were able to do at the market offerings, ATMs. And I think
Oh,
that's a
yeah.
much better way to raise money. In fact, I think it should be the only way to raise money. If I, you know, I think all these
You know,
deals they do. What's that?
don't you find it interesting that as owners of a company, which are the shareholders, they're typically the last ones to know what the financing terms are of any deal that they take?
It's a racket.
That to me is insanity, right? You look at when times are booming, these banks are throwing, financial institutions are throwing money at companies that don't need money, right? When times get tough, the financial institutions, you can't get any financing. Well, you can, but the terms are so toxic
Yeah.
that I understand the company's got a choice: either find some money or turn out the lights, right? But finding some money at the terms that they find it at is also turn out the lights. It's just down the road, right?
Yeah.
It's still the same path. You're going to have the same outcome because 200% warrant coverage at you're never coming out of it. You're going to dilute the hell out of
Yeah.
family and friends that bootstrapped you to get to go public, right? I mean, if you think about what companies go through to get to public, and then they think, man, I've built this thing that's going to solve this problem, and everybody's going to come buy it. And then they realize, well, no, I built this thing, but I can't get people, no matter how big of a problem this solves, for some reason it's not being adopted. And that's just because people don't like change, right? If we could change our focus and actually truly help companies, it's so challenging for any investor, I think, to know what companies are fluff, what companies' products are real, right? I mean, who doesn't want that company to succeed? Because somebody out there probably is making a lot of money having an inefficient system, right? There are so many things that is so hard as an investor that I preach all the time. Getting to know leadership is probably the best thing you can do, because if you don't have strong leadership, if they don't have a good understanding of the capital markets, I think the odds are stacked against you, right? No matter how good your product is.
So
Go ahead.
on that point there, Tim, maybe a bit. So the idea, retail investors, right? You're talking by and large folks that are not Wall Street veterans, right? They're not sitting behind a desk in New York or wherever they might be. They're construction workers, they're healthcare workers, they're whatever they might be, right? And they have almost an advantage, you would say, over many in the sense that they, if they're a construction worker and they understand where some of the risks are within construction, right? They can understand where the risks are, where opportunities are within healthcare applications. Would your recommendation be to these individuals to sort of invest in what you know and what you can touch and feel and understand, or should you try to become more versed in some of these other applications where there might be big upsides? Is there a sentiment that you would, when you were advising sort of folks on these strategies, what was your approach to that?
Here's my philosophy. I don't watch news, regular news. I don't watch news because there's so much negative crap in the world that it just would consume all your time. I don't do a lot on social media. I'm never taking a picture of my food or what I'm eating at what restaurant. I really, all of my time is spent looking for companies that I think can make a difference in the world, that have a product that is a need, not a want, something that is a need, a product that saves lives, right? To me, that is a product that at some point, it will be, it will happen because it saves lives. So, somebody's kid will wind up getting hurt or killed, and then it'll become in focus, and it'll be like, wait a minute, we have this. Why aren't we using this? And why isn't this the standard, right? We could make those things happen much faster. If you think about it, if Walmart, the big box stores, if they would have put up a big Walmart and nobody went to it, would there be a Walmart today? There would be no Walmart. It's the consumer that actually makes Walmart successful, right? But the consumer isn't buying the stock. They're just going in buying all the stuff from Walmart. Well, stop buying so much stuff and buy some of the stock too, right? Because you could have actually gone on that whole ride as the consumer. And I agree with you 100% that you almost have an advantage. You're nimble, right? Just like a small or a microcap company has an advantage. There's not layers and layers of red tape. There's not all these different departments that you have to go to get approval. You just see a need and you move and you try to fill that need, right? I think that's the most awesome thing about the stock market, is that you can find companies that are making a difference in the world. If you're concerned about the environment, there are companies out there that will take your organic trash and completely convert it over to organic fertilizer, right? What does that do? It reduces the size of the landfills and the greenhouse gases. And there are all these companies that are doing amazing things. Nobody knows about them. Nobody is their customer. You don't just have to be an investor. You can be a customer. You can be a brand ambassador. You can let other people know that this company exists, that there is a solution. And that's where you can make a huge difference, right? That's my thinking. And if you can recognize it early and you can become a brand ambassador and you confirm. Now let's just take an example. Construction company. Huge $7 billion a year annual construction company. Construction is 22nd, I think, in terms of adopting technology. Now, if they could have a product that would make their job site safer from the moment that they bring it on and make the job site more efficient, save money because you're getting things done faster, more efficient. You would think that this is simple to me. You would recognize it. Okay, validate that this does what it says it's going to do, right? If it does what it says it's going to do, then you go out and you buy the stock. And then you announce to the world that you're going to use this product on every future project. What do you think would happen to that stock? If a $7 billion company says, we're going to use this on why? Because it makes our job site safer and more efficient.
Ben, you jump in here. What's your thoughts in terms of investors applying sort of what it is that they know towards their investing, or should they, try to be a across?
Look, I think it's a great investing strategy. It's something that I haven't done enough of in my career, is seeing what's in front of you. What are people buying in the stores? What brand is becoming really popular as of late? I mean, Apple, Tesla. If you went into those early because you love the product, you'll get free apples the rest of your life and multiple free Teslas, right? TD Bank was a great example. It was actually founded in my community in Cherry Hill, New Jersey, and they revolutionized banking. I remember back when TD Bank opened, all of the banks they were like jail cells. Like everything was behind. I don't know if you remember this, Robert. When you went to the teller,
Yeah.
everything was like through a little slit in the window or whatever, and it was like really dark and guarded, and there were no Sunday hours. And TD Bank came in and they made everything bright and sunny and open and everything glass, and there was no, barrier between you and the teller. That bank was founded in my town, in my hometown, and it was like everyone loved overnight. It was like a revolution. Why didn't I think, let me go buy TD Bank stock, right? I would have probably made 100 times my money, right? So yeah, I think there's a lot to that. And it's definitely harder if you're a retail investor, if you're buying some kind of product or service that you can't validate. It's not tangible, it's not in front of you. It can get tricky, especially because there's a lot of, especially if it's like a Chinese company or something, but even if it's not, there's a lot of fraud out there, right? There's a lot of services you can't unless you do a lot of research on your own, you can't independently verify that this is actually a product and service that really truly is taking off. So I think there is something to what you said, Robert, to invest in things that are in front of you.
So if again, trying to put this in the context of what we're trying to accomplish in this conversation here, but are these types of investors looking at sort of these large bets, big upsides, versus nice 7% growth, 8% growth, whatever it might be? Is there a broad brush to be painted, or is it you know
Uh,
you talk
You're
to
talking
folks
about
all the
retail, you're
time.
talking about retail
I'm talking
investors,
about
Robert?
retail investors, right? I mean, you're interacting with these folks on an
Yeah.
everyday basis. If you said, hey, look, this story, I see this thing as a nice 8-10% growth, what's your response to that versus saying, hey, this is a 50-50, up 100 or down to zero?
I
Where are you going to get your most action and interactions with?
Yeah, look, I don't think you can draw a broad brush. There are so many different types of retail investors out there. Some who think more long term, some more about the vision and being a visionary, like we talked about earlier, they want to invest in whatever the company stands for. Some are more steeped in financials and balance sheet and capital structure. Some are looking for the quick buck. I don't think you can draw a broad brush. Looks like we just may have lost Tim.
Looks like we lost you there. Tim, can you still hear us though?
Yep, I'm back.
All right, sounds good. Ben, I apologize. I don't know if you can regain your thought there, but go ahead and finish up.
Yeah, so I just I don't think you can draw a broad brush for retail investors. There are all types of retail investors. If you wanted to percentage wise, right? Say, where percentage wise, what's the majority of retail traders now? I guess, acknowledgement to what Tim was saying earlier that, yeah, probably a majority of retail investors are looking for the quick buck. And, a lot of them are probably into like day trading and options and stuff like that. But, at least in my circles, a lot of retail investors, they're in for the long haul, and they're either investing in the vision of the company, or some of them are more steeped into the financials as well. But all kinds of different retail investors out there.
Something, and maybe Ben, I'll start here with you, but a big topic here has been interest rates, right? Um, Interest rates, one of you had mentioned sort of the dramatic climb that we've seen here in the last couple of years. We finally see our first sort of reduction in rates here, um, which has always been sort of thought of as that's what the microcaps need, right? Cost of capital is high, everything's expensive, financings are done at huge discounts, risk off, et cetera, right? That's all negative for the microcaps. The flip side of that is rates, every time rates have come down in the last 20 plus years, it has preceded a recession of some magnitude, right? Which then becomes a sort of a double-edged sword here to the situation. So, your sort of thoughts just in general, right? Not necessarily retail versus institutional or anything else, but your thoughts in terms of where we're sort of at, and what it means maybe more broadly for the micro and small caps, and then Tim, certainly add your thoughts afterwards here.
Yeah, I mean, the last 3 years have been brutal for small caps and micro caps because of the higher rates. And if you're a company that even has a hint of even a small chance of maybe having to do an offering, your stock's going to get punished and stay low. The only situations where you've seen small caps kind of reverse and start rising up is when the company is able to go out, whether it's justified or not, when they come out and they say, look, we now have enough money, we have enough capital to reach cash flow positive, then you start seeing some relief and you start seeing the stock turn around. Now that was under the last few years with higher rates. So there were situations where micro caps, small caps did great because they switched to profitability, they inflected to profitability. Now we got lower rates and, you know, it's better. No doubt it's better to have lower rates for small caps than the past regime the last few years. But you bring up a good point about possible recession, and but I don't know. I don't know that we're heading there. I don't know how long it's going to last. I think to some extent you do kind of need this Goldilocks scenario where you have low rates and no recession for small caps. But again, you only need that for companies that are bad companies, that all they have is the story. So you can have a Goldilocks environment where you're not making money, you're cash flow negative, but you have a great story, you have a great vision, there's some great product you're working on. It might take 5-10 years to get there, or maybe you'll never get there. In a Goldilocks environment, those companies can still do great, right? Because you get the retail investors who are just thinking about the vision and the sentiment and thinking long term, and they'll pile into the stock. And for whatever reason, the institutions decide not to short it in that Goldilocks environment, and up it goes, right? By but small caps, I think the key is to identify and be part of those stories where the company's inflecting to profitability, and whether you have lower rates or higher rates, that's where you want to be. That's a great situation for small caps.
Tim, what's your opinion?
I agree wholeheartedly with that. I think it's interesting that you have the NASDAQ and the SEC actually making it more challenging for micro cap and small caps. I don't know if I'm sure you guys are aware, you can no longer do a $5 million IPO. It's now a $10 million IPO. And the failure to maintain minimum bid price, you fall below $1 for 30 consecutive days, then you go on the clock. You got 180 days to get your stock price back above $1. And it used to be that if you were unable to do it in 180 days, you could file for an extension, get another 180 days. That is not the case anymore. Now the company has to essentially requalify to be listed on the NASDAQ minus the price. That is a big hurdle and a cost and expense for a small cap company. I think that will embolden the guys that like to short micro cap and small cap companies, because we just seem to keep making it harder for them to stay listed. And I could go into other areas, but I'm not going to because I don't want to get political on here. But anyway, I mean, we're making things really, to me, it's almost like we're anti-innovation. And it's so disheartening because I think small caps, in my view, are the backbone of this country. And those are going to be, some company is going to be the next Microsoft, the next NVIDIA, the next Apple. I mean, those are you've got 7 companies holding up the markets right now. I would say that those 7 companies are extremely overvalued. And I do think that we probably will have a recession of some sort, because that's typically what happens when you start cutting rates. And the fact that he cut 50 points when it was supposed to be, or a lot of people were thinking it was going to be 25, that tells me they're seeing something that they don't like. That's why it's 50 points, right? I think the Fed was way too aggressive because it takes a long time for all those interest rate hikes to work its way through the system. And I think he overdid it. And we've had revisions to the job. What was it? 800,000 revision to the jobless claims. I mean, that's insane to me, right? What data is he looking at? I mean, there is some very concerning things that are happening right now. And but I think that if that money comes out of those large caps, where does the money go? Right? I mean, it's got to flow somewhere. And I do believe there are a lot of small cap companies, just like you have irrational exuberance to the upside, you also have irrational pessimism to the downside. And I think there are companies out there that are not being recognized for what they've accomplished and through a very challenging business environment. And I think at some point, those companies will be recognized. And I think it'll be a rip your face off rally.
We got about 10 minutes left here. The audience here is likely some institutional investors, some retail investors, and some public company executives. Spend a minute talking to the executives, Ben, in terms of what it is and how they communicate to investors, right?
Yep.
What is it that they can be doing better? What is it that they should be doing specifically? Again, the topic here, the panel was on the retail investor. What is it that they should be doing in terms of their communication to the retail investor? Ben, you go first, and Tim sort of follow on here.
Yeah, I'm a little passionate about this topic because I've spoken to many CEOs over the years, interviewed many of them, given CEOs advice privately. And I think the biggest mistake that microcap CEOs make is they think retail is stupid, completely stupid, right? And they think that they could pull wool over their eyes, right? Um, Specifically, you know what if you make a statement on a conference call, some forward-looking statement or some new project you're working on, all right, we going back to this conversation about retail and they're very sentiment oriented, right? They're listening to the words of management. They're very management oriented because it's all about the future vision, right? They're not looking at the balance sheet. They're not looking at the capital structure, but they're listening to each and every word you're saying. Maybe not all of them, but the influencers, retail influencers are, and a lot of retail are. So when you talk about some progress you're having or some new product that's coming out, and then you go on the next conference call, their next press release in the next quarter, and you just don't mention it, right? And then you're wondering, wait, why is the stock down? I don't get it, right? It's things like that that cause your stock to go down, man. You can't get shit like that. Sorry, excuse my language. You can't get that past retail. All right. It kills your credibility. They're listening to every word. And again, because they're investing in moonshots, they're investing in sentiment, they're investing in your next product, and it just like disappears. And like every conference call, you're like randomly talking about 3 new projects or whatever it is, and there's no continuation, there's no acknowledgement of what you talked about last conference call. That really hurts me. And the other thing that what management needs to do, they need to acknowledge when there's a setback. They think that, oh, if I'm just rosy each and every single conference call and I only talk positively, that's what will get people to buy my stock. No, you got to acknowledge when there's been a setback, so we know you're on top of it, right? There's a setback and this is the reason why, and we're working to address it, right? If you just skip it, like, we know there's a setback, it's easy to see that you didn't meet your metrics or whatever. You got to acknowledge it, and you got to show people you're on top of it and that you're going to be solving that misstep or whatever it is. So I think those are the 2 most important things. There's a lot more to say on this topic, but I'll just stop at those 2 for right now.
Tim, I know you do a lot, and Ben does here as well, sort of these very long form videos with CEOs, and you're always giving advice. What's your general advice that you would give in terms of how they communicate, not just with the investing public in general, but sort of to these individual and retail investors specifically?
Listen, I think Ben nails it. I mean, transparency is number one. Engaging with your investors, especially in this day and age where you've got Zoom and you've got all these tools that you can use
to really engage with your clients, consumers, stockholders, right? There is a lot of opportunity that I think a lot of CEOs miss in this social media platform environment. You know, there are companies that literally could become social movements, and they don't take advantage of those things. I think explaining the why of why the company exists is really important to even if it's not directly, you have to make people understand why it should be important to them, right? Because maybe they're not thinking about the reasons that this product or service that they have can benefit humanity. I mean, let's take this as an example. If you've got a problem that costs our country somewhere between 30 and 60 billion annually, and you have a solution to that problem, and you could cut that 30 to 60 billion down to, I don't know, a billion of a problem annually, then what could we do with the money that we didn't have to spend on that problem? Could we put it towards better schooling? I mean, there are a lot of things out there that we may not think directly impact us, but they actually kind of do, right? The more efficient we can become as a society, the more problems we can solve, the better that is for everyone, right? And we're never going to get rid of all the problems. Humanity's got a lot of them, but we can get rid of a good chunk of them, right? And that can help us focus on the ones that are left. But we in this country are focused on a lot of things, especially right now, that really long term aren't going to matter. There are big problems out there that we need to address that will matter. And we're doing a terrible job of focusing on those. There are amazing companies out there, and I can't say it enough. Transparency and this too. Always. I don't know, Ben, would you say that companies are typically really bad at estimating what they're going to need for capital?
They're really bad at a lot of things.
All right, here, go ahead, Tim.
There, a lot of companies, you know, it's difficult for them to say, you know, we're going to need to raise capital. But like I said, the reason why companies go public to begin with is to raise capital, right? And growth consumes cash. So you can be a growing company, you're just not profitable yet, right? If you think about Tesla, if you think about Amazon.com, how long did it take for them to actually make money, to be profitable, right? They were growing, but they weren't profitable. They weren't cash flow positive, right? But somebody was willing to write the check. Somebody was willing to continue to support them. And that to me is a huge component, because if Bezos doesn't have somebody back in his play, Amazon doesn't exist today, right? So this for small and micro cap companies, you're not going to come out of the gate making money. You can cut to profitability, you can cut your expenses and cut growth, but then, you know, is that doing the right thing? They need to grow. You want them to grow fast, and growth consumes cash. Unfortunately, you have to hire more people, right? You have to get a bigger building. You got to do that. Takes time. And as long as management is clearly being transparent about what they're doing, like Ben said, don't avoid a conversation because you missed something. Address it head on. That is the best advice I think you can give a small cap company.
All right. Let me jump in for last couple of questions here, real quick. Social media. Back in 25 years ago when I started this, it was Yahoo message boards, right? Now it's obviously evolved in terms of where this information is at. Some of it is good, some of it is not. Ben, you're on these boards frequently. What's your general take? Has this been a positive for retail investors, or has it created too much misinformation, or companies that are leveraging it for means that aren't you know, the best for them?
Well, first of all, I think it's very important for companies to be engaged on social media in whatever capacity that they can. I think a lot of the conversation has moved over to X, someone StockTwits, YouTube, but X is really important. And net, I think it's beneficial for retail. I think there's a lot of educational opportunities for retail to be collaborating with other folks and sharing information. I mean, there's a wealth of information and due diligence I get from X, and you can curate your feeds and find experts on specific topics. So I think it's really important. I think you know, uh, it has its downsides, I guess, if you want to talk about like the herd action and the meme stocks and all that kind of stuff. But uh, net, I think it plays a good educational influence for retail investors, and it's a place that companies need to be engaged on and have a presence on.
Your outlook here, guys, for the last I don't know what we got, maybe 3, 4 minutes left here. Outlook for the markets over the next 12 to 24 months. Ben, you go first.
Unpredictable. I mean, this has been the craziest last 3 years. I mean, unprecedented since COVID. I mean, the amount of, I think, stress everyone's been through, personally, financially, with markets. I mean, just the volatility we've seen has been unprecedented. The things happening in the world, geopolitically, politically, unprecedented. I don't think anyone can predict what's going to happen in the next couple of years. I do think you don't fight the Fed, though. Interest rates are starting to come down, and I think you want to be invested more so in risk assets probably than larger caps. The last 3 years were all about the large caps, and hopefully, with lower rates, we'll see a shift towards the smaller caps. But to your point, Robert, is that going to come with a recession or not? So it's better to be invested in those small caps that are inflecting to profitability. So even if there is a recession, those companies will do well. So, short of it is buckle in, get ready for a wild ride, but I don't think you fight the Fed. Yeah.
There'll be a stock picker there, it sounds like. Tim, your thoughts?
Uh, I I I uh, I agree with that. I think after the election is decided, I think that will at least take some uncertainty out of the marketplace, right? I mean, then it's like, okay, well, this is our reality. Now what? Now what? What do we focus on? And I do think that it will be actually a stock pickers market, right? I mean, that's really what it's going to come down to, is the companies that are going to be able to weather a storm and have weathered the storm without blowing up their cap table. And understanding, I think for retail investors, the advice I would have is, it's great to understand the story, but you need to understand the fundamentals too. And that's really, really important. How many shares outstanding, fully diluted, is something that you should know, right? How many warrants or preferred shares, or all of that stuff is super, super important. So, but I think ultimately the markets will go up, because that's what they do over the long term, right? uh I wouldn't bet against America. That's what I would not do, is not bet against America, because I do believe we will come out on top again. So
All right,
Amen.
let's leave it there. Guys, Ben, let everyone know how they can sort of get in touch with you, where to follow you at.
You can follow us at Story Trading on all the social media handles, and my email is ben@storytrading.com if you want to touch base. Yep.
Perfect.
You want to talk about that retail outreach program, Robert?
Yeah. Go right ahead, Ben.
Yeah, we have a retail outreach program we've launched this year to help small cap companies communicate with retail, get their message out in the proper way to retail, educate them, help help build like a long-term investor base. So when your company is ready to flip to profitability, the investor base will be there, hopefully with diamond hands to see, see your business plan come to fruition. We're very active on social media with interviews on Twitter Spaces. We have a lot of partners that we partner with to help get the word out. So that's something you can be in touch with through Lytham Partners about as well.
Excellent. Tim, how can they get in touch with you?
You can follow me on YouTube, Alpha Wolf Trading, and that's where I interview a lot of CEOs that I don't charge the CEOs. I do it for free. And the reason I do it is I want to help the company get their story told. So if you want to reach out to me directly, it's tim@alphawolftrading.com.
Fantastic. Well, look, guys, I'm appreciative of the conversation here. Sorry for some of the technical issues here, but anyone that wants to get in touch with Ben or Tim, obviously, please reach out to them or reach out to myself, and I'm happy to coordinate an introduction as well. My email is Bloom, BLUM, @lythampartners.com. Again, we also have our YouTube channel where all the videos for our conference presentations are at, and again, that's just @Lytham Partners there. On YouTube. So guys, thank you so much. I appreciate the conversation. I hope you guys enjoy the conference here today, and I look forward to catching up with you guys hopefully at the next event.
Thank you. Been a pleasure.
Thank you.